All right. Hopefully, over the last couple of weeks, everyone has been following the chart every day, at least once a day, coming into the chart and trying to get an idea how the market is moving by looking at these bars, um, and also getting an idea how much the bars move. So, in other words, if you look up on this day here, this is a pretty good sized bar. This was the 7-2, and the range on that bar was a $3 move. And so if you've been following over the last few weeks, you know that that is a big move compared to all these other days. So on average, the daily move in oil is usually around 1.5 to 1.8 dollars. So when you see a $3 move, that's like a 90th percentile move. So it's a rare move, and it occurs, but it's not often. And why it occurs, I don't try to answer that question. I just try to look at things very almost statistical, like um, that's like out of a crowd of 100 people, that would be comparable to someone like a basketball player. Basketball player's height is usually in the 90th plus percentile. So by studying the daily chart, that's the kind of thing you get a hold of. How the market moves, what its typical move is, and you also get an idea of outstanding moves, like this move that happened on July 2nd, or vice versa would be this move here, which is a tight open and close, but overall the average range was consistent with the average range of oil, which is around $1, $1.50. So those are the kind of things you get by watching the daily chart every day. It doesn't really give you, um, well, we'll get into some other things, but the thing I wanted to do this week is to start adding a couple of indicators. And remember, we're still on the daily chart. So I want you to go into your studies tab and go to add study, then all studies, and add you're going to go to this column here and come over and add the average true range indicator. So you're going to add that, and this is what it looks like. It's just a line, and then you're going to save study set, and you want to call this study set global, like that, and just save it and press save. Okay, because we're going to be coming back and adding more things to global. All right. Um, so just a word on the average true range indicator. Its default is set to 14. What that means is that it's measuring the ranges over the previous 14 days and adding those ranges together, then dividing by 14 to give you an average, some average range that the oil market moves every day. So as of this day, July 5th, the average true range is $1.08. So that means that gives you an idea of the volatility of oil, meaning typically oil moves $1.08 up or down. This doesn't tell you anything about direction. It just tells you that that is the average move compared to what's been happening over the last 14 days. So if we closed um, today at 57.81, then $1.08 from that would be right here to 59.6. or $1.08 down would put you at um, 55.95. So that's kind of from this bar close, that's kind of where we would anticipate the price is going to move over the next day, either up $1.08 or down $1.08 based on the average true range. Okay, so that's one indicator that we want to add to, and the second one we want to add this week is the average true range. So you're going to come up here to studies, add study, go to all studies, and then you're going to go to this column, come over, and you're going to add the average true range trailing stop, like so. And your chart should look like that. Okay. And just a word on that one. The average true range trailing stop, basically what it does is calculating the average true range over the last 5 periods and multiplying that number by about 3 factors, 3.5. So if the average true range is 1.8, you're basically you're multiplying that number by 3, and that'll give you about close to a $6 range. So from this peak to here is about $6. And the math of that is basically is taking the average true range over the last 5 periods and multiplying that by 3 and giving you a realistic trailing stop as to where the market will not go. So it's kind of a way to measure where support is. So in this case, this range was broken here. So all of this time it was calculating that the range was moving lower based on the close. So this was all resistance. And then when this range was broken here, you see, this was probably a $6 range from here to resistance, $7 range, and when it was broken here, basically the ATR calculated this as support. So now we're looking at a $6 range from here to here. All right. So if I were to ask you what range we're in, basically we're kind of in this range here from the top of this candle, 60.24 to 53.76. So this is really the range we're in currently. And we're anticipating that this market is going to make new highs, and the average true range stop will trail along as that range is moving up. All right. And sometimes this is a very effective way to figure out where support is when you're calculating your trade. So how this is useful is, let's say we've been in this range for a few days and you wanted to enter long, you might go down to a smaller time frame and figure out where you are in that range. And this is kind of going forward into the next lesson, but on the bottom end of the range is where you want to get long. So your risk in this situation would be from say one of these candles to here, you're risking $2.50. Remember, this is a $6 range. So here would be $2.50 to get to the bottom of the range. And then if the market were to come back up to the top to make a new high, you would make $4. So this is risking 2 to make 4. That's just a example of where we're going. I don't want to spend too much time on that yet, but that's where we're going. But over the next few days, what I want you to do is just really follow what range we're in on the daily chart. So this is really another way to look at the range using the ATR Trailing Stop. There's not just one range, there's multiple ranges. And so now we're looking at bigger ranges, like, times 3 of what the average true range is. So that would be from this price, 60.38, to here, 53.61. So the range we're in now is basically a $6, almost a $7 range, okay? And you'll see that hopefully acting as a support. If you look back here, you saw it happening many times. So from here to here was a range, and the market bounced around in that range several times, and then went into a new range from here to here. Stayed in that range for a long time, and then went into a new range from here to here. Bounced around in there for a few days, and then it went into a new range until that range was failed. So that's the idea, is that we're trying to figure out what range we're in, and then when we figure that out, we can really kind of determine where risk and reward entries are, and where the ranges could possibly go. So to address that last point, this range basically kind of moved into a different level. So if you were to measure from here to here, you see this range here did a 100% extension, meaning this $6 range closed another $6 up here, right? So if you were long in here, let's say you basically entered here inside this range, and you risked $3. The 100% extension is $8. So you would have risked $3 to make $8. That's going a little further out there. I know that's a little more advanced. That's going to be one of our applications we're going to do in a different week. But this week, I really just want you to appreciate what range we're in on the daily chart using the ATR Trailing Stop. Do that for a few days before you move on to Unit 4, and then after that we'll probably start doing retracements and extensions and moving into lower time frames. All right, take care.